Bloomberg Audio Studios. Podcasts, radio, news. This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. The Bloomberg Businessweek Daily podcast with Carol Masser and Tim Stenivek on Bloomberg Radio.
I want to bring in Jay Goldberg. He's senior analyst, semiconductors and electronics with Seaport Research Partners. Jay is the only analyst that is tracked by Bloomberg that has a sell rating on Nvidia on the Bloomberg terminal. The price target is $100. Reminder, shares trading right now at about $182. Jay, good to talk with you. As always, is today the day you are going to be proven right?
My guess is no, but I don't think I'll be entirely proven wrong. Right. My thesis is that Nvidia is good company, good products. They have this Blackwell ramp coming now. But I think it's just getting harder for them. They've gotten so big so quickly. I think it's getting harder and harder for them to outperform the sector. And I think we'll see signs of that today.
Mandeep, what are you going to be focusing on? Is it China sales? Is it Blackwell, H20s? What will be the thing that will swing this or move the needle of this report?
I mean, China, I think is such a wild card that even Jensen, I don't think he has a lot of visibility into what the administration wants to do. So what is in their control is how Blackwell ramps up. And we know the ramp up of Hopper in the last 12 months. So clearly, from a unit shipments perspective, he can give a lot more visibility around how the customers are ramping up on Blackwell and what it means for gross margins, more importantly, because they have guided to gross margins going back to mid 70%. So that is something that consensus has in their numbers. And you want to see that visibility from the Blackwell ramp up.
That voice you're hearing from a man who needs no introduction. He's Bloomberg Intelligence Global Head of Technology Research, Mandeep Singh. He snuck in the studio after he was done with his TV hit, so we appreciate that, Mandeep. Jay, I want to bring you back in here into the conversation. In terms of numbers, the revenue consensus for fiscal Q3 revenue is $53.46 billion. There's a much wider range than usual going into that average. Where do you fall?
I'm at the high end. I'm at 52 billion.
Why?
For the quarter, 7 for next quarter. Like I said, this is the sort of the prime of the Blackwell ramp. This is the first quarter where we've really seen it in deployment across the web, and we're starting to see customers. People have been waiting for this for a year, and there was a fair amount of anticipation. When are we going to get them? Now that they have the systems, we'll actually customers are starting to see what they can do with them, which will determine how much more they're going to buy going through the year.
And on the China side, Jay, what is are you expecting any clarity on the situation in China? Because I know it's confused a lot of investors and analysts.
I think when it comes to China in particular and geopolitics in general, I've come to stop expecting clarity on anything ever. So I think we'll get some indication. The company has indicated that they're going to get a waiver for their Blackwell product to ship to China. That's a new product, a variant of Blackwell that they're going to ship. So I expect they're going to talk about that. I'll be listening very closely to see, though, if they've actually gotten the approval to ship it. I think that's still pending, but that'll be a big update if they've gotten the waiver to do that.
Mandeep, can you imagine a world in which NVIDIA does not have a presence in China? I'm just trying to imagine how hard it will be for NVIDIA to balance having a presence in the US and in China as well.
I mean, the good thing is they have de-risked the numbers. So when they guided for 2Q, they said 8 billion of the H20's revenue is going to be written off. So from that perspective, when people are looking at the print, they know there is zero China expectations. So, but to your broader point about, them not being able to sell chips to Chinese LLM companies, I mean, when you compare the LLM landscape, the top 4 or 5 companies are here in the US, and then they are there in China. No one else, when it comes to sovereigns or anyone else, has developed their own large language models. They talk about building infrastructure, but I think it's mostly for inferencing. So from a training perspective, the large language model companies are either in the US or China. So not being able to sell to China is a big deal, in my opinion.
Okay, here the numbers are crossing. Mandeep, you are timed perfectly. Second quarter revenue did beat estimates. Second quarter adjusted earnings per share coming in at $1.05. Second quarter revenue coming in at $46.7 billion. The estimate was for $46.23 billion. Second quarter adjusted gross margin, 72.7%. Second quarter data center revenue, this is the big one, $41.1 billion. Estimates were for $41.29 billion. Second quarter gaming revenue, $4.3 billion. That did beat estimates. As far as the outlook goes, Nvidia sees third quarter revenue coming in at $54 billion, plus or minus 2%. The estimate is for $53.46 billion. Another one worth repeating, that data center revenue for the second quarter, $41.1 billion. The estimate was $41.29 billion. Nvidia shares in the after hours, they're sinking, down about 8.6%, 9% as we speak. Mandeep, come on back in here. You're looking at this on the Bloomberg terminal on your phone. Why the downside reaction?
I mean, just the guide, the 3Q expectations were 54 to 55 billion. And to my mind, this print is not something to be excited about.
What about this? An additional $60 billion share buyback. That just crossing. A $60 billion share buyback when the stock is close to a record? What does that mean?
Well, I mean, this company is printing almost $100 billion in free cash flow. So it doesn't surprise me that they are using some of that free cash flow for buybacks. But if the top line is decelerating and we still have to wait for the call to see why they didn't have that big of a beat and raise given the Blackwell ramp, then the multiple will compress.
When that headline crossed about the share buyback, we did see shares give back some of those losses, now down 3.8%. Some other headlines crossing the Bloomberg terminal with regard to Nvidia. The company approves an additional $60 billion share buyback, $180 million release of previously reserved H20 inventory. Nvidia says no H20 sales to China-based customers in the second quarter of the year. I do want to bring back in Jay Goldberg of Seaport. He joins us from San Francisco. So Jay, shares down about 4% in the after hours. Certainly a disappointment when it came to that guide, as Mandeep said, but then there's that $60 billion share buyback. What's your instant reaction?
I think this is what I was talking about, is just getting harder and harder for them to beat the way they have been, right? I think we've all gotten accustomed to them having these massive blowouts quarter after quarter, and it just couldn't continue, right? This is by, any normal company, this would be an okay quarter, right? But it's Nvidia. We all have heightened expectations, and it was just, I think, very difficult for them to live up to it.
I feel like it's the outlook for sales of 54 billion plus or minus 2% that is fuzzy against estimates of around 53.46 billion. But in both cases, remember the wide range of analyst forecasts due to the unknowns of China. And I feel like this is what we've talked about, Tim, how there's such a broad range and it's hard to predict now, especially with China. But the all-important forecast for revenue, $54 billion, looks good compared with consensus.
I think it's okay. I think that the China swing factor is interesting because like a year ago, if somebody or some country or even some company wasn't able to take allocation of their chips for whatever reason, there would be a line out the door of other customers waiting to take those chips. And it doesn't seem to be that the line is that long anymore, right? There's still demand there, but it's not this sort of triple oversubscribed demand that they enjoyed a year ago.
We're speaking right now with Jay Goldberg. He's senior analyst for semiconductors and electronics with Seaport Research Partners. Also with us is Mandeep Singh. He is global head of technology research at this point. He joins us here in the studio. Mandeep, you're glued to your Bloomberg terminal right now. I'm glued to the live blog, listening to what you and Jay are saying, looking at headlines here. Investors will want to know what's going on with Blackwell. The company said that Blackwell architecture revenue grew 17% sequentially. What are you watching?
Yeah, and look, I think that's where the gross margins are actually trending in the right direction. So they did say they expect to exit the year with mid 70% gross margin. So that's a positive. The Blackwell ramp seems to be going well. It's just, when it comes to the aggregate number, it just is not that big of a beat and raise. And that's why you're seeing a stock reaction. But there isn't anything related to China that I can see in the print, which is what I was hoping. They gave some color around expectations for China for the remainder of the year.
Also in the live blog, we have Ed Ludlow. He's the co-host of Bloomberg Technology.
He's supposed to be on vacation.
TV. He's probably just tuned in for this. He says, curiously, the company says it benefited from a $180 million release of previously reserved H20 inventory from approximately $650 million in unrestricted H20 sales to a customer outside of China. What does that mean, Mandeep?
Well, I mean, they basically wrote off that inventory, and now they are able to sell some of those H20 sales. Remember, H20 is the deprecated version of Blackwell. So they're able to find a customer outside of China. And really, I think this points to some sales related to that. But I mean, 180 million is not going to make a dent, when we are talking a company that is expected to do 54 billion in revenue next quarter.
Jay, come on in on this, on the China question, the same thing that Isabel asked Mandeep with regard to what China is looking like, and Mandeep mentioning that he's not seeing any outlook in the commentary related to China. Do you have more questions right now about China than answers?
As per usual, yes. There's a lot of questions around this. I know from my conversations with people in the industry, there is a lot of demand for Blackwell in China. No one knows if they'll be able to get any or when they'll be able to get any. The company did say a quarter ago at Computex that they had a variant of Blackwell. It sounds like it's ready to go. They just need approval to send it. And it doesn't sound like they've gotten that yet, because they explicitly say there's no China sales in their outlook. In regards to the H20 sales, that's interesting, because the H20 is just a variant of the H100. It's a really simple operation to convert an H100 into an H20. It's 20 cents a part or something to make that change. The company had said that they couldn't ship any to anyone else. Only China wanted it. So it is a little bit encouraging to see them sell some of that, but not entirely surprising. I also want to point out that H20 margins are not quite as good as H100 margins. So there's a little bit of margin headwind there. But to Mandeep's point, $180 million for sort of China-related, China tangential sales is just nothing really to write about.
So our own Ian King, who covers semiconductors for Bloomberg News, is out with his write-up. The headline, Nvidia gives lackluster forecast, stoking fears of AI slowdown. The company giving a tepid revenue forecast for the current period. It fuels concerns that a massive run-up in AI spending is slowing. Is that a concern of yours, Mandeep?
I mean, I look at, their last 8 quarters. They increased the revenue sequentially by 4 to 5 billion. This is the first time when the data center sequential growth of 41.1 billion is up 5% from the prior quarter, which is the slowest growth. So to my mind, there's anytime there is a deceleration, the fact that they were growing sequentially double digits and now it's mid-single digit, even with the numbers that they put up, I mean, these are fantastic numbers, but there is a deceleration. And, when they're talking about new architectures, Blackwell, and the margins, as I said, is heading in the right direction, but that sequential deceleration in data center growth, to me, that is why you're seeing such a stock reaction.
So, Jay, I'll ask you the question now that the numbers are out. Were you proven right this quarter that you're the only analyst tracked by Bloomberg that has a sell rating on the terminal?
I'll take the win. I'll take a lowercase W in this case. I mean,
it's not trading at $100 yet.
No, but like I said, my thesis has all along been that it's just getting harder for them to beat expectations, and I think this is exactly what happened here. Right, to Mandeep's point, there's not much growth in data center. You read all the other headlines, it seems like AI is taking over the world, but in reality, I think we're going to need some time to digest the AI we already have, and I think it's natural that things slow down here for Nvidia, who's been leading for so long. Is
it a red flag to you in any way, Jay, that the company's authorizing this share buyback? Do growth companies do that, or is that more of a sign of mature companies?
It's a little bit of a red sign. I want to see how they talk about it. I mean, it would seem to me that there's so much opportunity out there in AI. Why not spend that $60 billion in furthering their growth? I mean, as a shareholder, I would appreciate it, but as an outside observer, I have to wonder, couldn't they find other ways to deploy that?
And the other big thing here is the CapEx increases from the hyperscalers. So we know Meta plans to increase their CapEx by over 30% for 2026. But for other hyperscalers, we don't know if they're going to grow by 30% or 20% or 15%. And that will trickle down in terms of what it means for NVIDIA's data center growth. So Google clearly is the one that relies mostly on their own chips. And, when you think about the incremental buyers for NVIDIA's chips among the hyperscalers, yes, there's Oracle and CoreWeave. But, if you take out China, sovereigns aren't going to make up for that incremental buyer. And if another hyperscaler develops their own chips, then that growth rate will come down. Again, it's a question of whether they grow sequentially 5%, 10%, and that will have a bearing on the multiple.
So NVIDIA's... Oh, go ahead, Jay.
I'm just going to say, and sort of going further with what Mandeep said is, if you look at the other hyperscalers, especially Microsoft and Amazon, they have some pretty big plans next year for their internal silicon, right? These are going to be big ramp years for their internal silicon. And I have to wonder if that's sort of chipping away at the edges of demand for NVIDIA.
That's Jay Goldberg. Jay, stick with us. Jay is Senior Analyst, Semiconductors and Electronics with Seaport Research Partners. We're also joined by Bloomberg Intelligence Global Head of Technology Research, Mandeep Singh, who's here in our studio.
So you both make the point that it's just hard to grow from here on out. How much of diversification is hinged on that? We know that 40% of the revenue is from Microsoft, Meta, Amazon, and I'm missing one. I'm blanking on that name. But NVIDIA now offers computers, networking gear, software services. Can we count on that? Mandeep, maybe you can go first.
Yeah, look, everyone knows this is a multi-year investment cycle, and data center spend when it comes to AI would be around $1 trillion. It's just the growth rate, right? So when you are underwriting 40 times earnings on a stock, there is expectations embedded in terms of the company compounding at, 30, 40%. So if that growth rate were to taper, then the multiple comes down. It's still a fantastic growth rate for NVIDIA. It's just the multiple compresses, and that's what I think is the risk here.
Do you share the same view, Jay?
Yeah, I think Mandeep summed it up pretty well, right? I think there's just it's good company, good products, but like this kind of exuberance seems to be getting ahead of reality of the market. And I have to wonder, you have all the hyperscalers spending these immense amounts of money, $500 billion among the 6 or 7 of these companies. It's hard to see them getting a return on that anytime soon, right? If you sort of look through it, I don't think they have a clear plan. They're building for something that's important and AI is coming. But in terms of sort of hard dollars and cents, the ROI on that massive investment, it's not clear how they generate that. And so I think we're going to start asking more of those kinds of questions. What are we actually going to use all this AI for?
Well, maybe Snowflake can answer the question. I want to bring Mandeep Singh back in here because he covers Snowflake. Shares of Snowflake up now about 11% in the after hours. The company gave a sales outlook for the fiscal year that topped analyst estimates, overcoming anxiety that software vendors will be hurt as the economy slows and new AI companies take away business. The shares jumped in extended trading. The narrative has been that software companies have been beat up for a couple of reasons. One, AI firms are able to do this. And two, a lot of the spending has gone to hardware and to expanding AI capabilities. What is Snowflake earnings telling us?
And actually, Snowflake earnings points to probably something that is incrementally negative for someone like NVIDIA, because so far, all the development in large language models was I put all the open internet data into an LLM, and LLM becomes smarter and smarter. But now what companies are doing with AI agents is they are training on their own enterprise data. That's where someone like Snowflake or MongoDB benefits, because your training is getting a lot more specialized depending on the use case. And it's not just about the compute cluster anymore, but also about the data. And I think that points to why Snowflake is doing well.
Mandeep Singh, you got to run. We appreciate you spending so much time with us this afternoon. That's Bloomberg Intelligence Global Head of Technology Research, Jay Goldberg. He is a Senior Analyst for Semiconductors and Electronics with Seaport Research Partners. Reminder to everybody, he's the only analyst that's tracked by Bloomberg who's got a sell rating on Nvidia. Stay with us. More from Bloomberg Businessweek Daily coming up after this.
You're listening to the Bloomberg Businessweek Daily Podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app, or watch us live on YouTube.
Well, for more on the economy, everything from tariffs, labor, productivity, and yes, the question of Fed independence, I want to bring in Natasha Sarin. She's the co-founder and president of the Yale Budget Lab. She's also professor of law at Yale Law School. She's got an appointment in the Yale School of Management's finance department, too. She worked at the Treasury Department as counselor to Treasury Secretary Janet Yellen. She joins us from New Haven. Natasha, good to see you. I want to start with referencing an opinion piece from Bill Dudley on the Bloomberg earlier today. He's former president of the Federal Reserve Bank of New York. He's out with a column today that says, up to now, he wasn't worried about the threat that President Trump poses to the Fed's independence. Now, he writes, he's much more worried, and he thinks the markets should be too. Does the president's attack on the Fed should we be worried about the president's attack on the Fed?
You should be, and I agree wholeheartedly with Bill. I think you're in such uncharted territory at the moment because, remember, this is coming on the heels of many months of the administration arguing that the Federal Reserve should be cutting interest rates in accord with the political whims of the Trump administration rather than based on its very particular dual mandate, which is about inflation and it's about the labor market. And the fact that we have a central bank that's independent, that cares about those two things and those two things alone, is a really significant source of our economic security. The way I know that is because we have experimented in the United States, as have other countries, with Federal Reserves that become politicized. In this country, in the Nixon administration, we had Arthur Burns, who was pushing for interest rates to help President Nixon get elected. And the result of that was runaway inflation that increased from 3 to 13% over a 2-year period. So we do not want a central bank that functions based on short-term political whims. And I'm really worried we're moving in exactly that direction.
The Fed said they will abide by what the court decides. And President Trump yesterday also said he will abide by the same. But if the court decides that Lisa Cook can stay, are we past a red line? Like, is the damage already done when it comes to the credibility of the Fed?
I hope that the answer to that question is no. And I really hope that what's important to note in the context of the legal discussion here is that the Supreme Court has really gone out of its way in a case about removal that had nothing to do with the Federal Reserve to signal that the Federal Reserve is special and that these types of positions, because it's a quasi-private institution with a particularly important role in our economy, these types of positions are really only for-cause removal positions. And frankly, for-cause rises to a level in legal nomenclature that it's pretty hard to meet in the context of malfeasance. And so I think that the court has already signaled directionally that they really think protecting this institution and protecting its independence is immensely important. And I hope that that's what they continue to say as this particular legal case plays out in the courts. But the thing that I'm worried about is the sort of institutional credibility and the view by the markets and by the public and by other countries and other investors that our central bank is independent from any type of politicization. That's kind of a genie that you can't put back in the bottle. It's something that's taken decades and generations to build. And I worry that it evaporates pretty quickly as a result of some of the types of attacks that we're seeing. So I'm hopeful that the judiciary is going to step in appropriately here, but I'm still really disheartened to see the types of attacks that you've been seeing leveled at the Federal Reserve of recent.
So let's keep your law professor hat on for a moment, Natasha, and talk a little bit about the definition of for cause in this context. You touched on it, but I'm curious if, let's say, the allegations about mortgage fraud end up, and we haven't seen the evidence here, that we don't have that yet. But when it happened, if it happened, matters. My understanding is intent matters as well. So from a legal perspective, why don't you think this would qualify as a for-cause reason?
I'm far from an expert on for-cause removal, nor have I looked at the specifics of this particular case, and nor, frankly, could we have at this point, because Lisa Cook hasn't been charged with any crime or anything. This is a set of allegations that have been leveled at her by the president and by the administration. What I can say is that in the particular context of removal with respect to the Federal Reserve, the court has been pretty explicit that it thinks it's important, and you saw it in the statement that the Federal Reserve put out yesterday. These are Senate-confirmed positions with very long terms that run cross administrations, precisely to try and insulate this institution from exactly the kind of political pressure that we're seeing levied against it. And this isn't just about mortgages, nor what has it been about the renovation of the Federal Reserve building, which has taken a lot of airtime over the course of the last many months. It's very clear that what's happening here is really frustration with the direction of monetary policy. And that's really no place for the administration to be acting. In fact, it's frankly counterproductive to their goals of seeing interest rates come down and seeing economic strength be very significant in this country.
We're speaking with Natasha Sarin. She's the co-founder and president of the Yale Budget Lab. She's a professor of law at Yale Law School and has an appointment, too, in the Yale School of Management's finance department. I promised we'd go all over, so we're going to move from the central bank to really what I think a lot of the market is kind of moving past, and that's tariffs. Because earlier this month, our team reported that the average U.S. tariff rate will rise to 15.2%. if rates are implemented as announced. This is according to Bloomberg Economics. It's up from 13.3% earlier and significantly higher than the 2.3% in 2024 before President Trump took office. Just today, the latest, the president imposed a 50% tariff on Indian goods to punish the country for buying Russian oil. That's the highest tariff in Asia. I'm wondering how you're looking at the fraying relationship between the U.S. and India and what's at stake more broadly when it comes to this tariff.
Importantly, what we should understand, and my colleagues at the Budget Lab are hard at work, by the way, updating our estimates with respect to what happens to the effective tariff rate and what happens to the type of revenue that we're going to see coming into this country. But roughly speaking, you've seen about an 8-fold increase in the average effective tariff rate over the course of the last 8 months of this administration, bringing in about $3 trillion of revenue into the country over the course of the next decade. Importantly, and this goes a bit to your point, Tim, it's never been super clear to me what exactly the objective is of this type of trade policy and where exactly it is that the administration is hoping to land. Because part of what you've seen articulated is that this is really about sort of China and national security and being sure that our adversaries are held at bay. In that environment, you really are quite worried about the idea of alienating allies and being particular with respect to not just India, but if you think about Canada and Mexico and other countries where traditionally they've been very strong allies of the United States. And in fact, we've been encouraging of more manufacturing to shift, particularly to India and Vietnam, exactly because it shifts away from China. And so a little bit feels like this policy has been kind of inchoate and all over the place. And it's hard to analyze like exactly why it is we're doing what it is that we're doing in order to be able to try and judge any success. What I can say is as a result of the tariffs so far, prices are going up and going to go up further. The economy is going to be smaller. And it doesn't seem like a win from the perspective of the American consumer or from American businesses.
I'm glad you brought that up because I'm curious if you think this will undo all the years of goodwill that the U.S. and India have built.
Well, I think that I'm worried about, frankly, is that you are in a situation where we are very exposed to particular relationships that it's taken to, and this actually relates to our conversation about the Federal Reserve, in that a lot of this sort of goodwill that you're describing are things that it's taken decades across administrations to try and build the types of working relationships with our allies that have made us this global hegemon and have made us a real marker of stability in the economy, a place that other countries want to invest in and other investors, both domestically and internationally, are keen to spend time in and around. And so what you worry about in some sense is not just, are you alienating one particular ally, or are you moving us, sending some other countries closer into the arms of China? Of course, you're worried about all of that. But also, I think what you're worried about is the general sort of chaos of not exactly knowing where these tariffs are going to land, not knowing if it makes sense to try and shift part of your manufacturing supply chain into India, because if India's effective tariff rate is 50%, it's no longer the type of place where you're going to want to be pursuing a lot of that type of business. So I think it makes decision making really complicated for the United States and for the businesses that are in this country. And it also runs real risks geopolitically that are pretty concerning.
I promised we'd go everywhere. We have a few minutes left, and I want to talk a little bit about the labor market and productivity in the context of record low birth rates in the United States, immigration that has come down quite a bit during this administration, and what it means for a workforce moving forward. How do you weigh those two things?
It's so interesting because I was actually talking to some colleagues or some friends who work at the Congressional Budget Office who have said that one of the reasons why you have productivity growth over the course of the next decade, that their estimates are going to average in the 1.82% range, GDP growth in the 1.82% range over the course of the next 10 years, is precisely because it's on the back of an increase in labor supply that comes from immigration. And the reason why that's so important is because, as you're describing, Tim, we have an aging population in this country, so a big chunk of people are going to age out of the labor force. It's really important that you have that supply coming in. In a world in which you don't have that supply coming in meaningfully and you've kind of shut down pathways to immigration, as you've seen policy-wise over the course of the last many months, you start to lose a very significant driver of labor force growth, and then you start to lose a very significant driver of productivity and broader economic growth. The thing that's interesting is it's happening at the same time as you're seeing potentially this productivity revolution that's coming from artificial intelligence. So in some sense, it's hard to know exactly how to disentangle those two effects as we watch the direction the economy is going over the course of the next many years. But restricting labor supply is going to have a pretty meaningful impact, particularly on sectors of the economy like construction and manufacturing.
But with AI investment booming, do you think that AI will be able to offset the lack of workers, whether in relation to immigration, the supply of workers that we have, or are we facing right now?
It's kind of hard to answer that question right now in some sense because it's hard to know exactly what to make of the very significant capital expenditure investments we're seeing in AI, and hard to know what to make about the role that AI is having in the labor force thus far. There's a great new paper by Eric Bronofson and co-authors where they look at the extent to which you're actually starting to see displacement in the labor force that has to do with artificial intelligence and its growth and usage across different sectors of the economy. And they do find that you're starting to see, particularly for younger workers who are in the most exposed industries, you're starting to see actual impacts with respect to their possibilities of labor force entry. And so I do think that there is going to be an effect here that's meaningful. It's just really kind of early innings with respect to this type of productivity change and shift, and early innings with respect to knowing whether AI is really a complement or a substitute for other aspects of the labor force.
Yeah, Natasha Sarin, co-founder and president of the Yale Budget Lab, professor at Yale Law School and the Yale School of Management. Thanks so much for joining us. This is Bloomberg. Stay with us. More from Bloomberg Businessweek Daily coming up after this.
This is the Bloomberg Businessweek Daily podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Certainly a lot of focus on Nvidia today, but do not forget there are other companies reporting today and tomorrow. In retail specifically, Kohl's shares surged after the company offered a more optimistic full-year outlook. Abercrombie and Fitch shares, well, they've been all over the place, as high as 3.3%, as low as down 10%. Investors are trying to decipher a mostly and modestly better than expected quarterly performance. Back with us to talk retail and more, Dana Telsey is here. She's the founder and CEO and Chief Research Officer of Telsey Advisory Group. She joins us here in the Bloomberg Businessweek studio. So, Dana, we still have to hear from Victoria's Secret, Dick's Sporting Goods, Dollar General, Best Buy, The Gap, Macy's. But we've heard from a lot of the big ones, Target, Walmart, and the like. It's not a monolith by any means, but how are retailers doing?
First of all, thank you for having me. I think retailers are doing okay. They're navigating this environment very well. Navigating it because sales strength exiting the second quarter is continuing. You're seeing the fact that consumers may be buying a little bit earlier to avoid any of the price increases, given the goods in the second quarter weren't as high tariffed as what you may have. And you know what else they're doing? Marketing spend is increasing. Product innovation is driving conversion. And denim jeans are working. You're seeing across the board, whether it's Kohl's, whether it's any of the other retailers, wide leg, baggy is hot these days.
Like I'm in 7th grade all over again. That's what it is.
Yeah, keep repeating 7th grade.
Yeah, it's what we wore. That's crazy.
Yeah, that's what's happening again. And the tariffs, yes, there definitely are an uptick, and you're hearing that consumers overall, we don't know what they're going to react to these higher prices. They're first expected to come late Q3 and into Q4. But the retailers are managing, frankly, a little better than what I would have expected.
So you mentioned sales strengthening. Do you view this as a sign of durable consumer strength or more like pre-tariff buying or because of the great promos we're seeing? How do you assess the health of the consumer?
I think the health of the consumer is pretty much okay. I think consumers are spending deliberately. I think the high end is traded down. We've consistently heard of Walmart getting the biggest growth from some of their higher income customers. You're seeing the Ralph Lauren's or the Tapestry drive average unit retail selling price increases with product innovation. And frankly, look today, Hollister delivered a double-digit same-store sales increase, which was impressive. And you look at Kohl's basically improved their proprietary brands because that value customer wants to see newness in proprietary brands. And let's not forget, we're going to get the last off-pricer tomorrow, but TJX and Ross were also solid. Consumers are buying ahead of price increases. Retailers are delivering product newness. It's back to school season, and everyone's still being discerning.
Another thing I'm looking at is retailers are still investing in store openings and remodels. So how much is that translating into traffic and conversion versus just being more defensive? I personally shop online and I don't go to stores anymore, but it seems like people still do.
They do. When you think about store openings in retail real estate, there is more demand than there is supply. There's not a lot of new development. Any of the closures that you've had, companies and retailers are taking them. The growth of whether it's a Five Below, a TJX, a Ross Stores, or Burlington, there's hundreds of stores that can open. You've seen the landlords overall pivot. Basically, grocery-anchored shopping centers can be lifestyle also, and vice versa. Wherever the consumer is located and near, it's more a focus on where can I get the goods. And yes, online is still there, but it's not either or, it's both.
We got to talk about these India tariffs, 50% on the country. It's upending ties with Modi and with a longtime and an ally that wants to even become closer to the United States. Exporters of clothing, footwear, and small manufactured goods like toys are bracing for falling orders and possible job cuts. What's going to happen as a result of these tariffs?
I mean, we saw it when it was just so high on China, too. Retailers work to do three things. They diversify their sourcing as fast as they can. They share the expenses with the suppliers and manufacturers. They raise prices to the end consumer. Hard to do this so quickly, and it's an obstacle.
There's a great chart in the piece that comes from data from the White House, and it shows that India tariffs are the highest of any Asian nation, 50%. But other countries, Laos, Myanmar, 40%, China, 30%. You've got Sri Lanka at 20%, Taiwan, Vietnam, Cambodia, Indonesia. I mean, these places I'm mentioning all export to the United States. Many of them are areas that have been diversified to away from China. So you can only diversify so much if everybody has tariffs.
Exactly. And you can't come back to the United States for all intents and purposes, given you don't have the labor and it's prohibitively expensive. What we've seen happen is we've even heard of some retailers who diversified away from China. They went back to China because the tariff became a little bit lower than some of these other places. Wow. It is moving pieces all together, and it's not staying stable.
When do we see it hit the actual price of these goods? Because up to now, as you mentioned, retailers are eating some of this, but how long can that go on?
Since April 16th, we've had a price tracker of 80 items. We price it every single week. We've seen some increases, but not across the board. Footwear is where we've seen the increases. Expecting that by the end of the third quarter into this fourth quarter, we're going to see more expansive price increases. and we're still not seeing it holistically across the board.
We also have to talk about interest rates, and with the potential to lower interest rates, how much support could that provide the shoppers for discretionary spending when it comes to the holiday and in the lead up to 2026?
Just the fact that we'll have lower interest rates is a positive for discretionary spending. It's something that takes months in order to really put in action, but the feel-good factor of it will lead to a more productive spend. At the same time, when you're looking at the labor market, we watch it carefully because we can't see that labor market weaken, because that will ultimately impact holiday season sales. The strength of back to school is a good pathway to holiday.
It seems like broadly you sound really bullish. What could be a headwind then? What could really buckle all of this development to the downside?
Labor weakening, price increases coming, and the consumer pulling back. That's why we say our theme is everything's good, but will consumers slow down? But will retailers have the inventory? Second quarter so far, though, coming in better than expected.
How's ultra luxury doing?
Slowed. Ultra luxury
Why
is
is
slowed.
that?
I think that you're not getting as many international tourists here to the U.S. You're seeing the Chinese not spend as much as they had been, and you're seeing prices for some of the luxury brands. Did they just get too high?
Interesting. So what are they doing to...
Well, look what the newest thing that just happened earlier this week. Louis Vuitton introduced a beauty line for Louis Vuitton. Usually,
This is the $160 lipstick?
It is the $160 lipstick.
Yeah.
But that is the newest thing they've introduced, and so they're diversifying the categories that they compete in.
Is that going to work?
Everyone wants a little bit of luxury. $160 compared to Hermes, which is $80, compared to Chanel, which is $50 or under. Let's see what happens. But you know what? One of the things is, for all different types of luxury, consumers will pay up if there's exclusivity and a desire, along with authenticity.
So it seems like consumers are trading down, and we don't see a lot of trading up. Is that what you're saying?
Yes, we're not seeing the trade up like it had been before. If you look at the Walmart numbers, you look at the TJX, they're searching for value to maintain their pocketbooks.
Maybe the lipstick will change it, Tim. $160.
Yeah,
you can do it.
I heard that there's like a really nice case that it comes into, and that's like a big part of the appeal.
And then the refills don't cost $160.
Oh, great.
In that
great.
case, it's a
More
real
affordable.
deal. Hey, Dana, always great when you join us on Bloomberg Business
Thank you
Week
so much.
Daily.
This is the Bloomberg Businessweek Daily podcast. Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.